As a Forbes magazine columnist for 26 years, Ken Fisher has seen more than a few market ups and downs. He's also got skin in the game. As CEO of Fisher Investments, he manages $39 billion. In his new book, Debunkery, he engages in one of our favorite sports at MoneyWatch, challenging conventional wisdom. Ken, thanks for being here.
Thanks for having me, Jack.
So early in your book, you take on a very timely point. You say that bonds are not always as safe as they appear. Can you explain?
Sure. Bonds fundamentally fall when interest rates rise. They rise when interest rates fall. And we've been through a prolonged period where more or less irregularly interest rates have been falling. But we've also had very long periods of time when interest rates have been rising. And when you go back through history, you find many periods, which I document in the book, where for very long time periods, bonds actually lose money many more years than not. People don't think that happens, and we're not used to that recently. But the fact of the matter is that really bonds are risky if we're going to have a long-term rising interest rate environment.
Sure. And given where interest rates are right now, presumably there's more room to go up than to go down.
If you take the time period from 1950 through 1980, you actually have more years where bonds lost money than made money.
You also don't like the formula that a person's age should roughly equal their bond allocation. Can you explain that?
Yeah, that's too simplistic, and most things that are too simplistic have something wrong with them. The real thing that's appropriate is to link your bond allocation, stock allocation, whatever, to what's really your time horizon. So one person could be 65 and likely lives 10 years based on genetics and their individual health characteristics, and they ought to have a portfolio maybe aimed at a 10-year time horizon. But another person could be 65 with a 55-year-old wife who comes from long genes and is in really good health, and the purpose of the money is to take care of the one of them that survives the longest, and now maybe you're talking about a 40-year time horizon. And with a 40-year time horizon, you don't really want a very big bond allocation. So you really want to think about the time period.
That's great advice. At MoneyWatch, we're big fans of passive investing, buying and holding index funds. And yet you say it's actually not that easy to do that. Why is that?
There's a couple of simple facts that people get wrong. First, cheap funds do better than expensive funds. No-load funds do better than load funds. But actually a provable fact is people that invest in load funds do better than people who invest in cheap funds, even though the funds themselves don't behave that way. And the reason is that the history of people who invest in load funds is that load creates a sort of a psychological prison for them, and they hold them for a really long time. The people that invest in passive funds and cheap no-load funds tend to in and out at all the wrong times, and they hold them for much shorter time periods and use them much more like trading vehicles. Very few people can do what you correctly prescribe, which is buy that cheap fund and hold it for a long time. They buy it, then they sell it at the wrong time, then they buy another different version of it at the wrong time, then they sell it at the wrong time. The average no-load mutual fund holding period is less than 18 months.
Ken, thanks for being here.
Thanks for having me, Jack.
And thank you for watching.